Well, I'm excited to welcome in my next guest. Earlier this hour, Elm Wealth rang the opening bell to celebrate the recent launch of its Market Navigator Fund. And joining me now with more is Victor Haghani. He's the founder and chief investment officer at Elm Wealth. Victor, welcome and congratulations.
Thank you very much. Great to be here. A really fun morning.
Fun morning indeed. I think green is the theme. We've got green behind us here for Elm, and we got a lot of green on the screen as well. What do our viewers need to know about this fund?
Well, our ETF, it's an ETF of ETFs, very low cost, very diversified, and it provides a tax-efficient way of getting dynamic asset allocation. So, I think people really like the idea that their asset allocation should change over time as market conditions change, but they don't like the idea that it's going to generate a lot of capital gains with all of the trading. But we know the ETF wrapper is pretty tax efficient, and so we think it's a real innovation, solving people's problems with wanting to be dynamic, but not wanting to bear an awful lot of tax consequences from being dynamic.
Interesting. What are some of the top holdings or makeup of this ETF that you can explain?
Sure. Well, we use low-cost ETFs, mostly from Vanguard and BlackRock. The biggest holdings are going to be U.S. equities. We hold VTI for the most part for U.S. equities. Other big holdings are European stocks held through VGK. Vanguard's European stock, low-cost index fund, emerging market stocks through VWO or sometimes IEMG, and we also own a lot of government bonds also through very low-cost index funds that give us government bond and other bond exposure in the U.S.
A relatively recent launch, as you were explaining there. What are your goals for the fund ahead?
Well, the goals are to really bring sensible, long-term investing to a broad audience, to give people a confident, comfortable way to own a lot of equities for the long term. And if you know that somebody is looking out for what equities are offering in terms of return and risk, and that they're going to change that asset allocation at different times, I think it gives people a lot more confidence to own more equities in the long term than if they just had to choose a number today as to how much they want to have in equities forever, right? Like to say, well, I'm going to commit to always having 60% in equities. You could do that. But if you know that somebody's kind of changing it, you might say, you know what, on average, I'm willing to hold 70% in equities, knowing that there's going to be some times when things are crazy, when we'll reduce exposure, and even other times when things are really good, where we'll be increasing exposures.
Interesting. And in terms of this market environment now, how would you describe it and any potential opportunity?
Well, I think that everybody would agree that we're in a very, very volatile market. And when you're in a very volatile market, it makes sense to reduce your exposures, right? That all else equal, the higher the risk, the lower the exposure you want to have. Also, there's a lot of volatility and a drift higher in interest rates, and that makes investing in fixed income a little bit more attractive. So in terms of our asset allocation, even though today we wish we owned more equities, we're keeping a relatively defensive posture in the portfolio, which has served our investors well since inauguration or so, with all this volatility and general drift down in equities. But today, it doesn't look so smart, but that's where we are.
Well, certainly we do see a lot of chop in this market. I think you bring up a good point. What would cause you to maybe take a less defensive stance?
Well, I think the two things that would cause us to do that, and it's built into our rules-based approach, is A, for the market to settle down. This extreme volatility of the market being up and down 2-3% every day. We need that to settle down, and it will be clear when that's happened. The other thing that would really help would be if interest rates came down. If we see a drop of, say, 1% in interest rates, that's going to make equities look a lot more attractive and have us be less defensive.
Thank you so much for joining. Victor, great to have you here on the show, and great to see your company and fund up there on the podium earlier.
Thank you very much. Yeah.
All right.